Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Adrian Day, president of Adrian Day Asset Management, also manages the Euro Pacific Gold Fund. Now, Adrian, let's just quickly recap the setup of the markets and maybe some of the differences that you're seeing within the markets compared to last year. Because it was last year at the end of Q3, so about Q4 2022, when the downtrend in a lot of sectors finally stopped and markets turned. Markets continued to run really through most of this year, but if we're focused just on precious metals again turned in about Q4 of 2022 and ran higher through more or less Q1 of 2023. And then for the most part, flatlined. For gold, the gold stocks, unfortunately, those just got beat up after that run into Q1 of this year, something that we've talked about a lot. But now here we are again, more or less in Q4, markets started to take off again. However, that's been more of an uptrend through the whole year. And metal stocks, precious metal stocks, they have been trending a bit higher, more just in the last few weeks. But gold's been doing well. So, what are some of the similarities? What are some of the major differences you're seeing this year compared to last year's run at the end of the year?
Yeah, well, a good question, and thanks for having me. I mean, the biggest difference, obviously, is the macro environment. You know, a year ago, we were facing tightening, monetary tightening, and now we're facing potential monetary easing. You know, the extent to which we don't know, and some people, in my view, are a little bit optimistic on the timing, but nonetheless, we are facing easing as opposed to tightening. So that obviously is a very, very big difference between this year and last year, and obviously very bullish for the metals and the mining stocks, as well as the market in general. I think also, you know, the stocks, particularly the gold stocks, the big difference is they're so washed out right now. Well, say a month ago, they were more washed out than they were at the comparable time a year ago. And so money flowing into the sector has an outsized impact on the returns. Yeah, I think we're set up, personally, I think we're set up for a very strong 2024 and 2025. It's not all going to be in one direction, of course, but I think the setup is much, much stronger. The companies are stronger, margins are robust, the macro environment is much better, and the macro outlook is much better. So both on a macro basis and on a micro company basis, much better setup this year.
Well, Adrian, just one more on the overall macro setup. If you think back, 2022, like you say, we had that rate hiking cycle, but we also had a war breakout in Ukraine, which kind of spiked the commodities back in the early part of 2022. And we saw something recently similar with the Israel-Palestine conflict, where there was a geopolitical factor. But the big mover has been interest rates, the dollar, and how they react to Fed policy. But there's also people talking about supply demand. There's all those other elements. When you look at the precious metal sector moving into next year, what do you think it will be that causes the precious metals to not just break out, but to have a sustainable breakout? Will it be a mix of geopolitics, macro, the rate cutting cycle? Will there be other things germane to just the metal supply demand? What do you think the big drivers will be?
Yeah, well, gold is a monetary metal. It's money. And the monetary factors are always, in my view, they are always the most important on any longer term basis, not necessarily in a very short term. So all these other things that you mentioned, and there are many others, the supply, the demand, China, you know, ETFs and so on, are all, or certainly most of them, are lining up in favor of gold, but they all tend to be either relatively modest or relatively short term. You know, geopolitical factors is a very key one that a lot of people focus on, because when there is a geopolitical event, gold will tend to spike sharply. And so people think, oh, geopolitical turmoil is good for gold. But when you look back, frankly, over 40 years, in the vast majority of cases, the impact has been only short-lived. And if there was no monetary factors that were supporting gold, then gold tended to fall back quite quickly. And we saw that clearly with Ukraine, Russia, in 2022. Within 3 months, gold was back to where it was before the Russians even started massing their troops, let alone when they started invading. So they tend to be short-lived. And the same really with Israel and Hamas. There was a spike, obviously. But if you look at, let's say, the last 6 weeks, when the situation in Israel, Gaza looked as though it was getting worse, gold didn't necessarily move up. And when it looked as though it was easing, when they were releasing hostages, gold didn't necessarily fall back. So the initial impact, was powerful, but then it goes away very quickly, in my view.
Well, Adrian, let's focus a bit more on stocks then, because it's one thing that I really like to read over what you send to subscribers and clients is your take on individual stocks. You cover a lot of royalty companies, and royalty companies have been generally more active, putting money to work in juniors, in development companies, getting at least a little bit of exposure to some of these projects. Now, I think a lot of companies that are taking royalty money is simply because they were having a lot of trouble financing otherwise. But how do you think royalty companies are set up as we transition into the new year?
Yeah, no, that's an interesting question. And if we can just look at, let me do a little bit of history, if I may. If you go back 50 years to when Franco-Nevada first became the first gold royalty company, for a decade, for 2 decades, the vast majority of transactions were companies buying legacy royalties that already existed, normally from landowners. So the landowner would lease the mineral rights to a company and retain a royalty. And the companies were buying those legacy royalties. And that was what we thought of for a decade or 2 as a royalty company. Then, of course, we had the streaming concept come along, and we've had a lot of bells and whistles on both royalties and on streams since then. But the thing I want to drive to is the type of deal that the companies are doing changes over time. And so 10 years ago, for example, we had a lot of deals from primarily Wheaton and Franco, because they're the large ones with the larger balance sheets. But we had a lot of deals where they were repairing the balance sheets of the major base metal companies. So $500 million and $1 billion deals to repair balance sheets, and in exchange get the byproduct gold. Those were great deals. They were great deals for both companies, but I think particularly for Franco, which has some 40, 50, 60-year mine lives on gold byproducts. And of course, there aren't an awful lot of gold mines that are going to be around 60 or 70 years from now. There's some, but not a lot. Whereas with the base metal companies, particularly, say, the copper companies, that's not an unusual mine life. So that was one big sort of theme, if you like, that lasted a couple of years. Now, that's no longer, a possibility. BHP, Rio, Teck, they're not looking to repair their balance sheets at this moment. The balance sheets are fine. And so the royalty companies, we'll call the royalty and streaming companies, we'll call them both royalty companies if we may. So the royalty companies sort of shifted. And as you mentioned, the big theme for the last couple of years was helping the single asset developers to develop their projects and bring them into production. And they were helped with that both because equity markets were bad, so it was expensive to issue too much equity. A lot of the banks, particularly in the United States and some of the European banks, were simply not lending to gold mine development anymore. So borrowing money became a little more difficult. And anytime something's more difficult, it becomes more expensive. And then even debt. So debt was more expensive, even though interest rates were low. And so the streamers were able to offer financing that became relatively more attractive. I think we've switched. We're still seeing that, of course. But in the last, I would say, 12 months, because of a shortage of really big deals, you are seeing even the large companies, particularly Wheaton, but also Franco's done some, but particularly Wheaton, do a whole series of very small transactions. You know, $20 million for Franco is not going to move the needle, however significant that mine becomes. But they're doing a whole series of these smaller transactions to put money to work, while the big deals are sort of not so much available. So what I'm trying to say is that the sort of theme, the opportunity theme, changes over time, but particularly the larger royalty companies with strong balance sheets are very well able to adapt to that. And you've seen that very, very clearly. I think going forward, we're definitely going to see a continuation of financing for development of assets. And we're beginning to see those assets come into production. I mean, next year, we're going to have a whole slew of those companies come into production, where Tocantinzinho is a good example, where Franco financed them not just with a stream, but also with equity and debt. It's kind of unusual for Franco to do that. But again, the money just wasn't available for one of the best mine building teams in the business. And Franco knew the people well. There was some crossover, if you like, with former directors. So they put a package together that included debt and equity at a better value than the company could have got financing from other sources. And they did it in order to get the stream. So anyway, a lot of these deals that the companies did, 1, 2, and 3 years ago, they're going to start coming into production. Cote in Ontario is another good example. IAMGOLD's Cote. That'll come in production next year. So yeah, it's beginning to monetize, and we're going to see more of that. There's no question. I think we're also going to see royalty and streaming companies finance mergers and acquisitions, but both of them. Yeah, we're going to see that. So yeah, so I think the opportunities are certainly there, and the companies, particularly the largest ones, are able to adapt very, very quickly to the opportunities without overpaying.
Well, Adrian, also in the royalty and streaming space, we've seen other companies approach it a little different. There were certain companies that bought baskets of royalties from larger producers. I'm thinking of Mavericks and also Nomad working with a strategic partner before they were both acquired by Sandstorm and Triple Flag. And we've seen other companies take the model of royalty generation through more of a prospect generator model. So I'm thinking more like Altius, or what EMX has done, or what Elemental Altus have done, where they have properties, they option them out. And so now there's a mix of these small to mid-sized companies that are doing deals that maybe wouldn't entice a Franco or a Royal Gold, but there's all these other companies out there. How do you look at those small to mid-sized royalty companies? Do you think we'll see more M&A and consolidation? Do you think we'll see any of those diverge from some of the bigger companies as far as performance?
Yeah, I'm not sure that we're going to see any of the larger companies buy a mid-tier royalty company, as a whole. But your question was about the smaller ones. Yeah, I think we're definitely going to see some, we had a flurry of merger activity a couple of years ago, sparked by Gold Royalty's hostile takeover attempt on Elemental. And that provoked or sparked a flurry of mergers and a lot more merger talks, frankly, that never came to fruition, to try to make themselves bigger so that they were, more easily could defend against a hostile takeover. But that theme seems to have gone away. But you continue to hear among the junior royalties talk about getting together, to produce bulk. Larger isn't always better. We know that. Larger is not always better, and that's particularly true for big mining companies. Sometimes they can just actually add to the complexity. But with royalty companies, theoretically, bulk is very, very important. They have to have the diversity of assets to avoid one asset, really hurting the company. And you saw that early on with, say, Sandstorm very early on, had a problem of one of their royalties, and it hurt the company significantly. There's a little more to that story, but we don't need to go there. But the point is, as a company gets bigger, they're able to diversify better, which is very, very important for a royalty company. They're also able to do larger deals and to do larger deals at better valuations, which is obviously critical. And so I think all of the smaller royalty companies recognize that, size is important. I think we're going to see more of it. I'm not sure at this point, who's going to be the consolidator and who's going to be the target. But there's no question we're going to see more of it. Yeah.
Well, let's carry that over to the whole sector, because we have seen quite a flurry of M&A activity, both mergers. A lot of juniors have been merging with each other to build larger a portfolio of projects, sometimes combine cash resources. We also have seen a couple acquisitions made of more advanced assets. Anything out there caught your eye, Adrian, and what, again, has been a flurry of activity over the last month to two?
Yeah, I rarely do I buy anything where the potential for that to be taken over rates as one of my main reasons for buying something. I will buy something because I like it, thinking that there's this possibility they'll get taken over, but I don't buy just for the takeover. But I think we're going to see more of the sort of thing you were just talking about. Two juniors in the same area, same district, getting together, to become more attractive for a third party takeover. So an example would be what you're seeing in Guyana with Reunion and G2 Goldfields. We own G2, by the way, we don't own Reunion, but I think at some point, whether it's next year or 3 or 5 years from now, even, you're going to have to see those two companies combine in some way or another, at least combine some of their assets, the ones that are close by, and a third party will probably come in and take the two over. Another example would be Aurion up in Finland. A little bit more complicated situation. We were talking about it before we started recording, but you've got Rupert up there with a big discovery in Ikkari and a more advanced discovery, but not necessarily exceptionally inexpensive right now. You've got Aurion, which has a joint venture with B2, but it also has a lot of 100% ground, which is more greenfields or less advanced. But significantly, it also has on its own property, the property in the joint venture with B2, it has part of the Ikkari ore body. So I would think that any major company that wants to take over Rupert to develop Ikkari is going to want the piece of the Ikkari deposit. And it's not just a piece of the deposit, but it's where you would put it's a strategic piece of a deposit. They would want that. Now that's owned in joint venture by B2 and Aurion. So I don't think they're just going to give it up for peanuts. So how this situation plays out is not known, obviously, and there's a lot of possible combinations. And you've also got major companies that are in the area. B2, as I just mentioned, is very interested in Finland. They talk about it at every conference call and every meeting you have with them. And then you can go up to Kinross, Agnico, and also Newmont is sniffing in the area, although frankly, I don't think Newmont would be the consolidator after Newcrest. But Agnico has a mine up there, and it would make sense for them to try to consolidate Rupert and Aurion. The complicating factor, of course, is that Aurion can't just say, yeah, we'll sell, because the most strategic piece of ground they have is in joint venture with B2. So anyway, all of that discussion, and then you've got share interests. Agnico owns some of Rupert, Kinross owns some of Aurion. I'm just trying to give the impression that these are two companies, two projects of it just makes absolute sense for them to come together. Management of Rupert wants it to happen. Management of Aurion wants it to happen on the right terms, of course. But you've got these other players. So how it all works out in the end, frankly, is anyone's guess. But I would say that if you buy Aurion at 49 cents, again, whether it's 1 year, 2 years, or 3 years, you're going to be a winner. You may not be the winner, but you're going to be a winner in that area.
Well, Adrian, that also brings up an interesting point about the role that strategic investors have in companies and if it can actually complement or sometimes hurt potential mergers. Because when you think about what you just laid out there, Kinross owns 10% of Aurion, but B2 Gold has a JV with them. You've got Agnico Eagle that has a little bit more of a stake inside of Rupert. But just on a broader discussion, we see this a lot. We see larger companies taking 10% or 19% stakes in juniors. And the question arises, does that block other companies from being interested in those companies? Do you eventually have to work it out? And we've also seen some potential mergers and acquisitions recently blocked by other companies taking 20% stakes to block the takeover. So what's your thought on strategic investors in general?
Yeah, no, I agree with your comments and you know, the inference that I draw from them. Yeah, I mean, generally speaking, you know, I think it can be a stumbling block to other people, even looking at it. You know, if you're a company, mid-sized company, and you're looking at different deals and you see, you know, whatever, Kinross owns 19.9% of a company, you probably don't put that to the top of your list and say, oh, let's look at this one a bit closer, because a big company has such a large stake. And also, as you know, sometimes when they negotiate these stakes, they always have the right to maintain their percentage ownership, but sometimes they even have rights in case of new equity issues to even more than that. So, you know, typically, of course, those things are negotiated when the, what we'll call recipient company is flat on its back and isn't in a very good negotiating position. You know, joint venture is a little bit different. Yes, there's no question that just, we're talking as it were hypothetically, but using real names, Rupert could not just go in and buy, you know, B2 has to agree. So yes, there is that does also cause a problem. But on the other hand, the amount of work that's been done would not have been done if they hadn't had the joint venture with B2. I would say that situation up there is probably a little more complex and complicated than most. And it's sort of come about as a result, frankly, of a discovery. You know, if Rupert hadn't made a discovery, we probably wouldn't even be having this conversation. So it's a result of success rather than anything else. But that is a bit more complicated than most. But I mean, again, there's always this issue when you're an exploration company and you don't have any revenue, you have to dilute somewhere. I mean, you either take on debt or you dilute at the property level or you dilute at the company level. But you have to dilute the interests of your shareholders some way or another. And the issue always is, of course, at any particular moment in the market, is debt cheaper than equity? Is it better to dilute the property or dilute the company? You know, and that's a moving target. And, you know, you can say, I prefer to do this in theory. And some people do. There's some companies that say, I never want to issue a royalty, or I like debt because I can pay it back from cash flow. So there's people who have theoretical preferences, but it really comes down to what's better at any given moment in the market. And obviously, when interest rates are 0, it's a different situation than when interest rates are 5.5. And when the XAU is at 180, it's a different conversation when the XAU is at 60. So it is dependent on the market. But one other thing I must say before I forget, and that we're talking about junior explorers that don't have revenue, and then you mentioned some of the smaller royalty companies that are royalty generators, including Altius, which of course is not such a small company and is not in gold either, but as you know. One you didn't mention there was Origin. Origin is a royalty generator, but it's in a very enviable position that they actually generate free cash flow. So their G&A is completely covered. They don't have to go out and raise capital. And, when I'm looking at juniors it's obviously nirvana to see a company with a strong balance sheet and with positive cash flow. But generally, when I'm looking at juniors, I'm always looking at what the balance sheet is, what their need to raise capital is, and how easily they will be able to raise capital. That's always, number one for me.
I think that's a good thing to stick to as well. And we've all seen that over the last couple of years, is just how tough it has been for companies to raise money. So then, Adrian, I guess into next year, is there a sweet spot or a certain type of resource stock or gold stocks that you are focused on that you think, quite frankly, are just in a better position no matter what the markets do?
Yeah, well, your question, no matter what the markets do, the answer would be clear. That would be the large royalty companies, because they tend to hold up much better if we do have a setback or a pullback. But looking at what we see for the year ahead, or certainly the next 6 months, year, I would say gold companies across the board, frankly. But I'm putting the focus, as I mentioned last time, I'm emphasizing the major mining companies as well as the major royalties more than I normally do, just because the major companies will be the first beneficiaries of generalist money coming into the sector, right? So when so-and-so's, global value fund says, I think we'll buy some gold, they might buy gold bullion or gold ETFs, and they might buy Newmont or Barrick and Agnico or Franco or Wheaton, but they're not going to buy Consolidated Ajax. So the big companies will be the first to move. They always are. And that's where I would focus right now. But having said that, there's value across the board. And some of the exploration companies are incredibly undervalued right now. I think the key, though, always is to make sure you buy something that has either a good balance sheet or cash flow of some type or access to capital, a sponsor, for example. I mentioned Origin as a company, that has positive cash flow. Another junior prospect generator, royalty generator that has positive cash flow is Mondaro. And Mondaro has just started buying back shares. They just did that today. So again, it's unusual for a junior company to have positive cash flow, but there are some of them out there. But no, frankly, I think there's bargains across the spectrum. You just need to be much, much, much more selective with the smaller companies, because as we all know, not only are they more risky in the down market, but they don't all necessarily go up, even notwithstanding that saying about a rising tide raises all boats, sometimes the boats have holes in the hulls. So, we've seen that before. Whereas the larger companies, as I've said many times, you could say Franco, Wheaton, I'm just naming them, Newmont, Barrick, and Agnico. If you bought those 5 stocks, you can be as close to guaranteed as anything is in the investment business. So if gold goes to 2,500, those 5 will go up. That's almost guaranteed. Whereas it's not guaranteed that Consolidated Ajax or Amalgamated Moose Pasture will go up.
Yeah, very good points there, Adrian. Thank you very much for your time. And hey, hopefully we just have a better environment here for a lot of the stocks, but we've heard it from a number of people. Be selective, select the higher quality stocks, and hopefully ride them higher as this market picks up and as they do the work that they need to advance their projects. Adrian, thank you as always for your time. I hope you have a very happy holiday season, a happy new year, and we will chat again in 2024.
Yeah, well, thank you, and Merry Christmas to you and all your listeners as well. Thank you.